You watch my videos because I provide you value by teaching you how to read price. Then I help you build your intuition by providing you solid examples. Each time you click on a video of mine, you are investing in yourself, and your investment is your time, and your return is your knowledge that you get from these videos. That's one of the best returns from an investment. So keep investing in yourself, my friends. Now, let's learn how to read price. So, as I pull it up right here, let's just bring up a random chart, right? Let's go to like, I don't even have this chart on here. Let's just pick like a random one. Let's go with like AUDJPY. So random. I don't even know. I just looked at it, caught my eye, whatever. And then it looks like I made some markups on this in the past, whatever. We're going to delete everything, right? We're not going to use anything at all. Now, I prefer to start on the weekly time frame. You want to begin with your higher time frame, begin there. And to know your weekly direction, to then know the likelihood of an up expansion close candle or a down expansion close candle, that we're trying to find like which way is the weekly going. And then this is going to later provide us some daily bias. Just keep watching and I'll explain. But you must look at the weekly external range liquidity, then internal range liquidity, and understand which was ran into most previously. Was it internal range liquidity? If so, then external range liquidity is the next draw on liquidity. If it was external range liquidity, then internal range liquidity is the next draw on liquidity. And internal range liquidity are fair value gaps, big gaps in the market, fair value gaps. Also, like order blocks, up close candles support price lower, and down close candles support price higher. And so, like, those are forms of internal range liquidity. External range liquidity are these old swings right here, right here. This is external range liquidity in these areas, right? Just old swings, right? And so, like, with all of that being said, we're going to start with what was recently tapped into and traded away from, right? You can see that this on the weekly time frame, we had this external range liquidity, or not external, my apologies, this internal range liquidity right here, this fair value gap. We tapped into that fair value gap. We ran past that fair value gap into this external range low. And we also tapped into this external range low, right? So, with that being said, we just recently tapped into these lows right here. So, external range liquidity to internal range liquidity, obviously, it likely hasn't happened yet. The markets closed yesterday. I'm recording this on Saturday, so the markets are currently closed at the moment. But with this weekly close, you can see that it's providing like a good like candle range theory opportunity, that CRT, where it closes within, and then this next week we could possibly look for an expansion higher to then take out the first candle of the CRT patterns high over here. If you know, you know. But I don't want to elaborate upon that. We could just kind of go back to this point, right? This is the most recent tap into liquidity. Obviously not these are, but let's just say it is, right? So then you can confirm the next draw on liquidity by going to where the weekly is trading away from, which is internal range liquidity, towards external range liquidity within these areas. Let's just say as soon as it taps in with this green candle, right? With this green candle right here, at these moments from this markup, right? It taps into internal range liquidity. We want to confirm that it's going to go to the next draw on liquidity, which is external range liquidity. And to do that, since it's a weekly, we're going to look for a 4-hour market structure shift bearish towards the next draw on liquidity, which is this swing low down here. Then from that point, we want to confirm if like 4-hour PDAs, which are fair value gaps in order blocks, we want to confirm that old bullish PDAs opposite to our bearish indication get closed under, and we want to see them get disrespected. And at the same time, we also want to see new PDAs in our favor bearish get created and respected. This becomes your weekly bias, and you hold that bias until we run into that next drawn liquidity, which is this swing low over here. So if we drop into that 4 hour, right, on that initial touch of that weekly internal range liquidity right here, we're gonna then look for a 4 hour market structure shift bearish. Now, um, market structure shifts, they do require a closure below the very most recent 3 candlewick swing, which includes displacement, creating a fair value gap, and the change in the state of delivery, aka disrespecting old PDAs and creating and respecting new PDAs. Okay. So, with that being said, as soon as it taps into it right here, looking for that 3 candlewick swing low right here, we have the most recent one right here. And we just follow price. We look for the newest, most recent ones that get created. We have one right here, have one right here. If you have questions about what are these 3 candlewick swing lows, drop a comment so I can make a video about it specifically for y'all. Whoever's questioning and doesn't know exactly what are the 3 candlewick swing lows, right? So boom, we have this 4 hour candle close right here below the most recent 3 candlewick swing low. Right there, it also includes displacement, creating fair value gaps. Also, the change in the state of delivery by closing below these last two up close candles. You draw it from wick to wick right there. This becomes a breaker block. Okay, this is a breaker block as soon as it closes below it. And with that being said, once we tap into it, because remember, it just disrespected also this bullish fair value gap. Boom. Disrespected it by closing below it, creating newer fair value gaps as well. And as soon as price taps into our first PDA that provides us our first entry opportunity, which is going to be this breaker block right here, we are going to take our sell position. We're going to put our stop loss right above that breaker block, and we target a 1 to 2R. Boom. And we hit our 1 to 2R, right? Take your profits. Don't be greedy. You're not holding forever, right? This is the weekly market structure shifted bearish, right? And this was on Sunday. Look at this is how the weekly candle formed, right? So Sunday opened right here. Sunday opened and it went high, creating that manipulation, right? So it accumulated, manipulated, and the accumulation on the lower time frames, it created the swing high right here and the swing low right here. So it engineered liquidity on both sides of the market. It swiped liquidity to the upside, creating the breaker block. It then market structure shifted bearish, creating new PD arrays, disrespecting old PD arrays, creating displacement, a change in the state of delivery, and then you take your entry off of that. Now, the logic behind it is we tapped into a weekly fair value gap. That's internal range liquidity. We are then targeting external range liquidity. Even if it doesn't happen right away, I mean, obviously it doesn't happen right away with this big expansion higher, right? So you can see that price isn't yet ready to take off. That's why we don't hold past a 1 to 2R. You don't want to be greedy. You have to just take and look for more opportunity in the future. Don't be greedy. I've learned this the very hard way. Okay. So right here, we hit that 1 to 2R, right? And price is not finished yet. We tap back into that fair value gap on the weekly time frame. We also turtle soup this high right here, right? If you don't know what a turtle soup is, it's like whenever price takes out external range liquidity, but like there's sometimes external range liquidity within the internal range liquidity. Game is game, bro. Like I'm telling you, there's a lot to kind of learn about it. You know what I mean? It's interesting. But with that being said, you can see that it expanded up higher, created new bullish PDAs. You know what I mean? Now it's like, maybe this isn't so bearish. You know what I mean? So with that being said, we're looking for the most recent 3 candle wick swing low. It's way down here. We're just going to bring a new one up here, way down here, and we're going to follow the newest ones that get created. We have this one right here, and then we have this one right here. Again, if you're confused about this, drop a comment, let me know, so that way I could elaborate on them in future videos. We have this one right here, we have this one right here, and I'm drawing them off of this one right here, and then we have this one right over here, we have this one right here. Price closes below it, right? But it's not a huge displacement. It doesn't close below it with a lot of like, you know what I mean? It doesn't like, it's like, not really. Like, in my opinion, this is a internal range liquidity turtle soup, because it turtle souped these external range liquidity lows right here, and within this it's like within this big internal range liquidity fair value gap area. You know what I mean? It's like within that area, and so I would consider that a internal range liquidity turtle soup, right? And then you can see that it does expand higher. Obviously, we're reading this in hindsight, whatever, bro. You know what I mean? But from this point, you know what I mean? It goes up, and we're looking for the most recent 3 candle wick swing low, which is right here, right? And then boom, we close below it right here. Okay. We close below it here, and you can see that it kind of displaced down by a lot, and it created fair value gaps, new PD arrays to the downside, disrespecting old PD arrays, and this is a breaker block, right? Up here. Now, it doesn't market structure shift until this candle closes right here, right? So how could you really find an entry? Well, right here, you can see that there's this fair value gap here, right? And price taps into it. Now, at this point, when price taps into it, since this is a 4-hour fair value gap, obviously we like took an entry over here a little early, right? You could scale in on these positions, right? I didn't scale into this one. This was just hindsight. Obviously, I'm just trying to make a quick video, and we're building our intuition. Now, how could you have found entry right here? We had this fair value gap, right? As soon as price retraces up and taps into that fair value gap, because we're on the 4-hour time frame, we could drop to the 15-minute time frame and look for a market structure shift bearish, right? And so if we drop down to that 15-minute time frame, boom, and we go back to that area where we were just back testing within. So we are looking for that market structure shift bearish. And whenever it taps into it, the most recent 3 candle wick swing low, it's about down here, right? And then we just follow them. Look at how it creates this bearish fair value gap, taps into it, right? And again, we're following the 3 candle wick swing lows. We have this one that gets created right here once it taps into that fair value gap, creating new PD arrays, respecting them. Market structure shifted bearish with a huge displacement candle. That's the displacement that I'm talking about, bro, right? At that point, we also created that fair value gap, that change in the state of delivery, creating this little mitigation block. I would consider it, dude, because it's not a breaker block at all. You could even consider it just a small little, you know, bearish order block if you want to consider it that. And after that close over, I would set my sell limit right at that order block right there, right? Boom. Stop losses go above that order block. Boom. They go above that PD array that you enter off of, right? And you target a 1 to 2R. and you get out at that 1 to 2 hour. Boom. And you can see that it happened right after it tapped in. We got our 1 to 2 hour in and out. Boom, boom, boom. That's how you scale in. So you tap into a weekly fair value gap. We did that. We looked for that 4 hour market structure shift. We did that. And then whenever price retraces into that 4 hour PDA within that market structure shift area, that's whenever you drop to the 15 minute, and you can look for that market structure shift as well, changing the state of delivery, disrespecting old PDAs, creating new ones, and you can enter in off of that. This is how you do it, right? So again, we got our 1 to 2 hour off of that 4 hour market structure shift area right there, right? But if we go back to it again, we had that market structure shift. We got our 1 to 2 hour right there. It was not ready, right? It had this big retracement, right? And it created this bullish fair value gap right here, right? If I just move this right here, boom, it created this bullish fair value gap, and it closed over these down close candles right here. And then it started respecting and going higher, right? And now up close candles are closing over down close candles, creating bullish order blocks, new PDAs, and is starting to disrespect old PDAs, right? And at this point, you can kind of see we did tap into this fair value gap. We tapped into this order block, right? Once we tapped into that, we did wick down, right? Could you have found opportunity? I don't know. Let's go see on the 15 minute. Again, we're kind of back testing together. We're building each other's intuition. I'm building mine and we're building yours. Okay. So we tap into that and let's see if there was like a market structure shift opportunity right here, right? This was the most recent one right here. And then it came down, created this swing low right here, closed below it. But look, it doesn't have much displacement besides this one up here, right? Still, let's see. If we draw it out, we close below it. It did come from this whole area and it's creating this fair value gap here. It wicked into it, respected it. That's a bearish turtle soup right there. Confirms price going lower, creates this fair value gap right here. So with that, price comes up, taps into it here, and it also taps into that last up close candle. This is considered your breaker block candle right here because of the turtle soup action that happened over here. Boom. And then it got closed below, right? So you got that change in the state of delivery. You got that market structure shift bearish. You have new bearish PDAs being created, old PDAs, fair value gaps getting disrespected and closed below. Price taps into that order block. You can take entry off of that order block or take entry off of that fair value gap, right? So let's just say that we took our entry off of that fair value gap. Let's see if this offered us a 1 to 2 hour. If it didn't, losses happened and that's okay. We're going to put our stop loss above the order block up here. And it hit a 1 to 1. Now, question for you traders. If price hits a 1 to 1 R, would you go break even on your trade? Drop your answer in the comments below, please, and let me know why you would go break even or why you would not go break even, because I really want to know. I want to understand like what your opinion is, you know what I mean? Because I just want to know. I truly do. It helps all of us to understand everybody's perspective because all of us have our own intuitions and experiences within these markets. So let me know. With that being said, though, it offered a 1 to 1, but then it came up and took us out. Let's just say we took a loss right here. That's totally fine, right? We took a loss. Losses happen in these markets. Newsflash, If you thought you could win every single trade in these markets, you're wrong, bro. Nobody in the world has a 100% win rate. I'm sorry, it's just not possible, not one bit. But right here, you could see that it expanded higher, right? It disrespected our 4-hour market structure shift. It's still within that weekly fair value gap, bearish fair value gap, right? And so we're going to look as soon as it taps back in, disrespects all of that. Where's the most recent 3 candle wick swing low on the 4-hour? We see it's down here, right? Boom. And then we get a new one created right here, right? And then we get a new one created up here, right? Boom. So right here, this is your market structure shift point. Price then, boom, violates the hell out of it, creates a bearish fair value gap, creating new bearish PD arrays, closed below this bullish fair value gap, not with this candle quite yet, but pretty much closed entire thing. This is where it closed below that. But it's disrespecting old PDAs, creating new PDAs, and then you can see that this up close candle right here would be that last up close candle order block. Price doesn't come back into it. But then this whole run right here, this could be considered that. I don't like to get that big. I like to stick to like smaller areas of interest, because if you have big areas of interest and you take an entry off of it, then you have to put your stop loss to cover that whole thing. Screw that. That's too big of a stop loss. It's harder to get a 1 to 2R when you have a really big stop loss. It's easier to get a 1 to 2R with the smaller stop loss. So the smaller PD array that you take your entry off of, again, don't just base that off of that, but it's going to offer you an easier setup, right? So with that being said though, right here, order block is really high. I always say take your entry off the first PDA that gets tapped into, right? And price taps into that PD array. It also had that change in the state of delivery, closing below some of these up close candles. Boom. That's all of our market structure shift action right there, right? And then price taps into there. We could take our 4-hour entry right there. Boom. And then we put our stop loss above the fair value gap 1 candle, right? Or you could put it above the order block. Same thing, it's above both of them right here, right? So we have a pretty safe stop loss, and we target a 1 to 2R, right? 1 to 2R was hit if you took it off the 4-hour. Now let's say that you're looking to dollar cost average into this position, right? Now, someone asked me, what is dollar cost averaging in the last video? They were like, can you kind of explain that? And so I have this right here to kind of explain what is dollar cost averaging. And I'm just going to read it off for you guys. Let me pull this up right here so that way we can see. So dollar cost averaging is an investment strategy in which an investor divides their total investment amount into equal portions and invests these portions at regular intervals, regardless of market conditions. And this approach helps reduce the impact of market volatility and lowers the risk of making a large investment at an unfavorable time, right? So how dollar cost averaging works. So you have a fixed investment amount, right? So let's just say you invest a set of money like 1%, okay? And you want to buy more when prices are at a better discounted rate. So like if you're like in our situation, we want to sell at a higher price, right? But if you're buying, you want to buy at a lower price, right? So um with that being said, you want to kind of like break your 1% up into like, if you're gonna like take 3 different positions, I only take 2. So I'll enter my initial 4-hour one, which we just did. That was what was, exampled right now. And then we'll take a second one whenever we scale in to the 15-minute, because it's a 4-hour PD array. We're going to drop to the 15-minute and look for a 15-minute market structure shift. And that's whenever like we pretty much enter the other half of our investment. So if I'm comfortable with risking 1%, I'm going to split it up in 2. That 4-hour entry I just took, that's going to be half, okay? Half of 1%. Now I'm going to look for a 15-minute market structure shift to enter the other half of the percent for a better like entry opportunity, right? And the benefits of dollar cost averaging is it reduces market timing risk. So uh like a lot of times traders they use this to not have to predict like market highs and lows, you know what I mean? And then it mitigates emotional investing so that way it avoids like panic buying or selling. And like this is kind of ideal for like stocks, ETFs, and crypto, but I use it in forex just to kind of break up my entry a little bit better. And this kind of helps me maintain consistency, which is really nice. There are some potential drawbacks where you may miss big gains and opportunities like that 4 hour that we entered. What if it never tapped into that 4 hour PDA and it just melted or whatever? You know, it may miss out on that opportunity. And it's usually less effective in like very bullish markets where it's just like kind of taking off, you know what I mean? Where price keeps rising. So like dollar cost averaging could result in a higher like, you know, it never drops lower for me to enter like better. You know what I mean? Let's bring it up right here. We're gonna drop from our 4 hour. Now that we entered our half a percent right here, we're going to drop to the 15-minute, look for a market structure shift bearish opportunity to then enter our other half, giving us a better entry, a better risk percentage. And so with this right here, let's go to that original tappage of the 4 hour fair value gap tappage. I like that. I like that word. So the original tappage is like right here, boom, 3 candle wick swing low, boom. And then it creates this one right here, boom, 3 candle wick swing low right there, boom. And then you can see right here, displaces and violates the hell out of that 3 candle wick swing low market structure shifting point, creating this bearish fair value gap, disrespecting this bullish fair value gap right here and this bullish fair value gap right here, closing below these lows like hell. Yikes. What's telling you that this is still bullish after this candle, right? And it creates this up close area right here. This is a bearish order block for me, right? And so with that being said, soon as price taps into this fair value gap right here, boom, right then and there, because again, we take our entry off the first PDA that gets tapped into, we could take our entry opportunity right there. Stop loss would go above the 1 candle of the fair value gap, right? And we target a 1 to 2R. Holy smokes, we didn't get that. And that's okay. You lose sometimes, right? Now, again, we can see what happens over here, but let's just imagine that we didn't, right? Let's just imagine that all we seen was this right here, right? At this point, this is where it's like I'm taking my entry off that fair value gap. I am managing my risk. This is the half a percent right here. Boom. We get stopped out, and that's okay by me, right? With trading, you don't win everything. It comes up and it taps into this order block. Now, what could we have done better right here? Again, we're back testing, we're bettering our intuition, building our knowledge. We could have just drug our stop loss a little bit higher to be a little bit safer, right above that order block, right? And if we would have done that, we would have been safe and sound, right? And we would have hit our 1 to 2R. Okay. So this is helping us. So going forward, what should we do better? We should put our stop loss, if it's close to the second PDA, like stop loss area, like it was here, because we put our stop loss above the 1 candle of the fair value gap that got tapped into right here, right? But this order block is right up here. Now, why would we put our stop loss up there? Because multiple PDAs that are bearish are gonna provide a lot more resistance to price to go lower. Think of it this way, like, right? this is the first wave enemy, right? And price runs into the first wave, beats the shit out of them, right? Bop, 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 knocks him out, right? Gets into the second wave, which is this big order block right here, right? And the second wave, he's a big buff strong man, right? He's like freaking huge, right? Price runs into him and pop, pop, pop. They put up a strong fight, both of them. They go back and forth. But at the end of the day, this big strong man, he said, "No, I'm too big for you," and freaking knocks him bearish, right? Sends price way lower. That's why you want to put your stop loss above that. You want to think of it in waves. If the first wave gets knocked out, the second wave boss can take him out, right? Just a little like what is that, an analogy? That's actually pretty funny to me. That's cool. Anyways, so yeah, we had that right there. Boom. Okay. And at this point, right, now that the 15-minute is telling us that is telling us market structure shift bearish. With that being said, the 15-minute should continue creating like bearish PDAs and respecting them. But then from this point too, price should then be bearish as well, right? On the weekly time frame. Once the 4-hour market structure shifts, respects that market structure shift, it's going to create these up close candles, get closed below, create these fair value gaps, bearish PDAs that get tapped into, and then get disrespect or get respected, sorry, and then close below these more up close candles, and it's just going to keep sending price higher. Now, with that in mind, from this point here, this is Wednesday, Thursday, Friday. So the rest of the week, and by the way, all of this that we have done so far up to this point is all the MMXM sell model, right? MMXM, market maker sell model. All of this is the market maker sell model, bro. Like over and over and over again, right? We go internal range liquidity, look for that MMXM market maker style model. Boom, we're dropping it, right? So with that being said, the new weekly candle, because 4 hour is bearish, we anticipate these next weekly candles to then close bearish and give us bearish opportunities too, right? So this next weekly candle, if I just drop like a little line right here to kind of show you how this weekly is looking at this point, don't worry about looking forward. Let's look in the past right here, right? So this weekly candle, it wicked up and it closed below. It turtle souped these highs over here and it closed below this previous candle's low, right? That's it. Also had that market structure shift right there. So in your mind, what you're going to do now is you're going to look for the weekly power of 3. You're going to look for the weekly accumulation at the open. You're going to look for the manipulation that goes high, and I'll show you what it goes high into. And you're going to look for the manipulation that goes high, distribution that sells off. We're going to get in on the manipulation to then get in on that sell opportunity that breaks it down, bro. Okay. So the weekly candle right here, power of 3, I'm going to delete that. Boom. Weekly candle is going to be opening on Sunday at 17 right here. So it opens here, right? So since we're bearish, since we had that market structure shift bearish, since the weekly candle closed so bearish, and 4-hour PD rays are creating bearish ones, respecting them and disrespecting old bullish ones, we are going to look for a bearish opportunity. So we want the price to open and look at how it accumulates down, creates these lows right here, and it engineers liquidity to get ran into throughout the week, right? So it creates a low right here. It's going to place this right here. People are going to buy right here, place their stop losses below here, and they're going to hold. And a lot of greedy fools are going to keep their positions open for whenever we're selling off, right? So with that being said, it opens, it creates engineers liquidity, and then it goes high. This is the manipulation move. Now, what does price manipulate into? If it's a weekly candle manipulation, I like to go to the daily and I look to see for a daily internal range liquidity that it manipulates into. And you can see right here, internal range liquidity, fair value gap here. You also see this big order block area right here. Boom, right? So price taps into that. Now, within these areas, you can kind of imagine, well, this is internal range liquidity, external range liquidity is the next point of interest, right? And the external range liquidity from internal range liquidity is going to be that low that was engineered at the beginning of the week, bro. It's right there that I just drawn on for you, right? That's the daily external range liquidity that the weekly open engineered at the weekly start, right? And then it went higher and it tapped into this daily area of interest, right? And because it's a daily area of interest, what we're going to do is we're going to drop to the 1 hour and we're going to look for a market structure shift bearish, bro. Boom, dropping to the 1 hour. As soon as price taps into that area, right? Which is going to be right in this area here. Boom. 3 candlewick swing lowest so far. Creates this new one here. Creates this new one here. Creates this new one here. Price doesn't close below it. Creates this new one here. Creates a new one here. Creates this new one here. And then creates this one right here. Look at this. So this right here is the market structure shift bearish point. Price violates it, bro. That's displacement. That is beautiful displacement. Violates the hell out of it, dude. Creating new bearish fair value gaps, bearish PDAs, disrespecting old bullish fair value gaps. Look at how this bullish fair value gap held in the past. Price tapped into it with this candle, moved away from it. Price came back, found support at it within this candle, moved away from it, and then boom, we violated the shit out of it. At the same time, price creates this up close trio here, aka this mitigation block trio right here. This is a mitigation block, not a breaker block. This is a mitigation block. And it expands, market structure shifts, change in the state of delivery, creates this bearish PDA right here, this one right here as well. And it taps into all of that, right? So again, the first area of interest is right here, this fair value gap here. Once price taps into it, again, you can take your entry off of all these ones, but you don't want to be too greedy with it because again, if price just taps into this one and then it moves away from it and you were hoping that it taps into this and you miss out on your opportunity, then you miss out on your opportunity and you'll be pretty upset. But you could dollar cost average here, right? What if you take your 1%, you break it up and you take half that percent off of this one, and then if it taps into this mitigation block, you enter the other half a percent. And where you're going to put your stop loss at is above that one candle. But remember, it's so close to this order block area. Think of it as waves. You're going to put your stop loss above both of those areas. Boom. And then if you took your second entry off of that breaker block, look that you got a better entry opportunity, tighter stop loss. And with that, again, we target that external range liquidity. And look at this happen on Wednesday is whenever we got our entries. With the weekly power of three, do not ever trade Mondays, bro. It is a rule you do not want to break. Do not ever trade Mondays. Why? Because Monday was the accumulation. You never trade Mondays because it's just going to accumulate and it's just going to create liquidity to then be ran into or be manipulated and be taken out, bro. You don't want to be a part of that whatsoever. Excuse me. So, with that being said, you would then target the rest of the week, you would target that weekly low. Boom. That external range liquidity. But we're not greedy, right? Target a 1 to 2R, my friends. A 1 to 2R. Do not be greedy. 1 to 2R, right? Now, because we're targeting a 1 to 2R with this one right here, what I would do with the DCA position is I would hold it for that same take profit personally I know that is kind of being greedy, but what you can do too is like once you do hit that 1 to 2 R, then you could take like half a year position off and then target the rest, put your stops at break even. Again, this is where we all differ as traders. I want to know, comment down below. What would you do in that case, right? Would you target that 1 to 2 R and then claim full position? Or would you target this 1 to 4 R and then claim whenever you target with that 1 to 2 position? Or would you like target that 1 to 2, claim half, and then target the rest, putting your stops at break even? Or let me know in the comments below because I'm interested. I want to see how we all differ as traders, right? Because we do. And this is a scenario where a lot of us would think differently and be like, how am I going to manage my position? What would give me the best outcome opportunity? And with this, I personally, in my personal honest way of trading, if I took that DCA position, I would hold it for that 1 to 2 right here, um, area that I was holding the other one for, rewarding me a 1 to 4. So if I broke up 1% between two of them, right, and my half a percent hit a 1 to 4 R, then I hit what 2% on that position, and then the 1 to 2 is 1%. So in total, I made 3% on this weekly distribution because again, we manipulated on the weekly candle open, we manipulated into that daily fair value gap. And after that, we dropped to the 1 hour for that bearish market structure shift, right? And we got in on that. And we caught the daily, or not the daily, the weekly distribution. So this is the weekly candle. Now, this is beautiful, bro, because now that we have that weekly candle distributing, this gives you a daily bias throughout the rest of the week. The rest of the week now becomes bearish, right? So now, as you go into your daily candle open, you could look for that daily open high and it'll manipulate high into a 4 hour PDA. So let's just go to that, right? Let's just look at that. So the daily open will always be the midnight, right? Midnight open is right here on this candle right here, right? So this is where the midnight daily candle opens. Boom. So the daily midnight candle opens and it goes high. What does it go high into, my friends? It goes high into a 4 hour PDA, right? A 4 hour internal range liquidity. So it's right here. It opens and it taps into this 4 hour PDA. Boom. And this is where you could start looking into like the London session and like the London kill zone and things like that. But because it's a 4 hour PDA, what do we drop into? We go to the 15-minute and we look for that market structure shift bearish. Now, I want to remind you guys, we are looking for this daily power of 3. And within this daily power of 3, we are doing a market maker sell model off of the 15-minute, bro. It's all combined, dude. It's the same. It's this is how the markets move. This is truly all you need to learn and know. Like it's insane to me, dude. I love it. It blows my mind every time, dude. This video has so many gems. You might need to rewatch this over and over. I'm gonna rewatch this over and over and over and take so many notes, dude. Oh my gosh, this is fire. So we tap into it, right? The last 3 candle wick swing low is way down here. Then it creates this new one right here. And then we just follow it. Where does it create a new one? Right here, right? Boom. And then it closes below it. Not much displacement, right? But then this candle comes into. And with that, right? This right here, I would consider it a market structure shift bearish. It also closed below these up close candles. This is like you're changing the state of delivery. It also closed below this up close candle right here, right? And what else it's doing? It's creating these bearish fair value gaps. You know what I mean? To go lower. Now, this is where I'm like, displacement isn't there. But because we had a change in the state of delivery. We had a market structure shift bearish. We're violating old bullish for like PDAs, creating new bearish PDAs. This is where you're like, all right, price kind of might just be bearish, right? You have this right here, right where that market structure shift candle closed. So if you wanted to be a little bit more conservative, you could wait for this candle. Boom. This is a displacing candle right here, and it creates a fair value gap, right? Once this candle closes, and it also closes, it actually doesn't close below this bullish fair value gap, but it eats up majority of it, right? And it's taking out this leg too. This is giving you idea that selling is here. Selling is here, right? And what I would do if I'm dollar cost averaging here, I would take my first entry position right there off of this fair value gap. Boom. And what I would do is there's another one right here. I would break my position up into three. I would be like, there's so many PD arrays within this market structure shift leg. There's this bearish fair value gap. There's this bearish fair value gap. And then there's this bearish order block, right? This last up close candle that got violated, and now it's likely going to support price lower. If you did not see this side, this is how I would like to read price, right? This is why we're building our intuition, so that way we could approach price and be like, this is how I'm seeing it. This is the way, because we're also like applying a logic here. You know what I mean? The logic here is that the weekly candle is now distributing bearish. Because of that, the daily candles are now providing us a bearish bias. So now we are expecting the daily candles to provide a open. At the open, it's going to accumulate, and then it's going to manipulate into a 4-hour PD array, where the 4-hour PD array will then act as a resistance to send price lower. But to confirm that, we need a 15-minute market structure shift bearish to show us the market's hand telling us price is going to go lower. Okay? Crazy, dude. Crazy. That was a great explanation. So, again, with that being said, that's the logic here, right? So, if I have 1%, if I'm comfortable with risking 1%, I'm going to risk 0.33% of that position right here. My stop loss is going to go above this PD array. If I'm going to take an entry off of all three of these, if price comes into all three of these, then I'm going to put it above all three. Think of it as in waves. If price runs into this wave and it beats the shit out of this wave, it's going to run into the next wave. Beats the shit out of that wave, it runs into the next one, and that's the final boss. It's like, nah, this is where it ends here. Sends price lower, knocks him down, beats him down, he melts, he's done, I'm out. You know what I mean? That's what I'm saying, bro. That's it right here. You know what I'm saying? So with that, we have our first entry here. We have our second entry here. Boom. Another 0.33 going down. Now let's just say that that order block doesn't get tapped into and it just sends price lower. Well, that's again the sacrifice of dollar cost averaging. You won't get your full 1% in. You're only going to get 0.66 percent in right now. You know what I mean? That's a little over 0.5% right now. You have to choose as a trader. Would you dollar cost average? Or would you just enter your full 1% right here and just be comfortable with all of that as your stop loss? Or would you put your stop loss above the one candle of that fair value gap PDA that you just entered on? At that point, you would get wicked out. You would get stopped out. You would lose that 1%. In this situation, this is a very conservative approach, in my opinion. Sometimes you won't win as much because if it does take off and you didn't get your full 1% in and it hits that 1 to 2R, then what you win just a little over 1%, like a little less than 1.5%. You know what I mean? Whereas if you enter your full percent and it hits your 1 to 2R, you win 2%. So those are the sacrifices to dollar cost averaging. You as a trader have to choose, what do you prefer to do? But We tap into that fair value gap. We got our second 0.33% going down. And then we tap into that order block where we got our last 0.33% going down, right? Now we are entered in our full 1%. And this one we target a 1 to 2R. Now with me, I'm going to hold my dollar cost averages the same as the first position. That's how I prefer to do it as a trader. That's how I've seen all of my back tests work out the best, right? So I hit a 1 to 2R with this 0.33 right here. So I got 0.33 times 2. Let's do 0.33 times 2 equals a 0.66 win right there. Then we have a 2.75. So let's do 3 times 2.75 equals a 0.90. So we had that 0.66 plus 0.90. Lastly, we have that 3.65. 0.33 times 3.65 equals 1.20 plus 0.66 equals 1.86 plus that 0.90. My total return on this setup was 2.76% average. If you just entered your 1% here, you put your stops above here, you would have got lost. If you put your stops above the high up here, you would have been fine, but you would have only won 2%. If you would have just held these for 1 to 2 hours, right, then you would have made 0.66 times 3, about 1.98, about the same as the 2%. But because we held these positions for the same duration as this one, we made 2.76%, nearly 1% more dollar cost averaging and holding those positions for a better risk, right? This is how I approach trading. This is how I read price. This is the weekly. Now the weekly is going from internal range liquidity to external range liquidity, right? We had that 4-hour reacting off of that weekly PD array, market structure shifted bearish. This right here is the weekly open. And from the weekly open, not right here, sorry. This right here up here was the weekly open, low, high, close, open, high, low, close. Okay. Open, high, low, close. And now that we have the weekly distributing because the 1 hour confirmed the market structure shift bearish and the weekly is now distributing lower. This gives you that daily bias throughout the rest of the week to then go into London session or even New York session, depending on how London session played out. And you could still look for that, daily candle power of 3. And again, by dropping these lower time frames and looking for that market structure shift, as soon as you drop to look for that market structure shift, realize you are now looking for the MMXM model. And regardless, like throughout all of this, we're just deciphering price into a power of 3. We need to find the power of 3. We need to know what is the likelihood of an up close or a down close candle based off the weekly, and then that will provide us a daily bias, right? Man, this was an awesome video in my opinion. I'm super excited with how this actually turned out. I'm not gonna lie to you guys. Wow, we just went over an hour too. Probably gonna cut that out. Yeah, this was a lot of nuggets, you guys. I would rewatch this video over and over and over. I would send this to your family and friends. I'm gonna send this to my family and friends and tell them, come learn how to read price, right? This is the value you get when you come and watch my channel, right? It's awesome, dude. I love this. I am excited to continue to post videos like this, and I'm excited for what's to come in the future as well. But if you like this video, if you obtain some knowledge, If you got some value, please drop a like on this video. Help me out with the YouTube algorithm. Drop some comments. Let me know your thoughts. Answer my questions. I'd appreciate it. I want to know how you think as a trader too, and what you think the best outcomes would be as well. And if you're not already subscribed to the channel, subscribe for more future daily nuggets. I want to start posting every single day. And that's truly my goal this year, is to start posting every single day. And I'm excited to do that. So come join me. We will see you tomorrow in the next video. Bye, everyone.